You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, let's just start by talking a little bit about what day it is. Today it is Wednesday, November 10th. The markets are open and rocking and rolling while we're taping today. A lot of times we tape after the market. And the markets have been a little bit volatile. It's a big day for a lot of the EV stocks out there, including good old GM and Ford. Tesla's even doing okay today. Rivian Automotive actually went public. They had their IPO. They opened right around 109 once they first started trading. Right now we see it up about $26 based off of where it was supposed to open at. And it's trading at 103.77. So it is up today. Some people made the case that it could open as high as 120 overall. Those were some of the indications, and came open at 109. It's driven a lot of the EV marketplace up overall. Stocks like Ford had a fairly decent sized position in RIVN, which is the symbol. Also, Amazon was boosted a little bit because of their position in that underlying company overall, and they're going to be really close. That's what the word on the street is, as far as they're going to work well together in partnership in this little venture, and they definitely made a splash on the market this morning. Okay, so this week we had Coinbase actually come out and announce earnings. After their earnings report, the market was disappointed with them overall, despite the fact that they have launched a new marketplace that they've had a ton of subscribership for NFTs. So there will be a new, more solid marketplace to be trading the NFTs. Coinbase has a fairly good reputation, obviously, with what they've been able to do in the crypto space overall. We had Bitcoin actually set a new high today, a new all-time high. Now, it might not close there, but it did set that today. But yet, we still see Coinbase is down 25 points, last traded at 331.47. We still have some good volatility in that underlying stock as far as the options are concerned. We're seeing them trading right around an implied volatility of about 60% after that earnings announcement. So we're going to try to take advantage of it by doing a butterfly spread. As we mentioned before, that if you are correct on your forecast in a butterfly, you would like implied volatility to come down. So, as always on Options Playbook Radio, we're not trying to make recommendations overall. We just like to call them a paper trade. But we like to look at scenarios where the pricing in the marketplace and the price of the underlying stock might behoove you to do one particular strategy over another particular strategy. And when you have high implied volatilities, bottom line is butterflies are cheap. When you're going into that trade, if you're correct on your forecast, you want implied volatility to go down. A lot of times we do them on the bull side because of that. And we're going to kind of make I guess our forecast would be on Coinbase that it was a little bit overdone after earnings, a little bit too much of a downturn in general, and we're looking for a little bit of a bounce back. Now, we're not doing this based off of earnings. Implied volatilities already came in a little bit after the announcement. So we're going to go out a little bit longer in time. A lot of times when we're doing these trades right around earnings, we're doing the shortest expiration that is possible, but we're going to give this a little bit more time to play out. Now, on a butterfly, it's very important what expiration that you choose. And part of the reason why is that you're going to be selling 2 option contracts in the middle of that butterfly. And in order to make the maximum on the trade, you need those 2 option contracts that you sold to whittle away, right? Because ideally the underlying would be close to that strike price, and then that would be an at-the-money option contract, and you'd have to buy those contracts in to close them out, and the lower the price on those contracts, the better the butterfly is going to do. So what are 2 things that can drive down option premiums, especially if they're at the money option premiums, implying that your forecast was correct with your butterfly, is you have time decay, that'll whittle it away, and also a decrease in implied volatility. So in our instance, we're going to go out to the November 19th expiration. We are going to do this as a broken wing butterfly, which means we're going to try to get this done for a small net credit to the account. We obviously have a lot more volatility. And Coinbase in general is just a volatile underlying. It has a tendency to trade a lot with some of the cryptocurrencies, even though it's the exchange. And the more volatile the cryptocurrencies are, the more trades that usually take place on the exchange, and the better the company actually does overall. For some reason, if cryptos go up, Coinbase has a tendency to go up with them, and if cryptos go down, Coinbase has a tendency to go down with them. So today, the fact that Bitcoin set a new all-time high, and Coinbase is going down. Well, let's hope we get a little bit of the excitement about Bitcoin gets translated back into Coinbase, and get a little bit of pop-up in the short term. But definitely a speculative trade overall. There's going to be a margin requirement on this trade because we are going to have some risk. Whenever you're looking at a skip strike butterfly, that's what it's called inside the options playbook, otherwise known as a modified butterfly. But I like the term skip strike better, and I've mentioned it before here in Options Playbook Radio, because you literally are skipping the strike. If it was a standard butterfly, you would normally have the strikes equidistant apart. So the first option that you're buying, then you go up to the one that you're selling, and then you go up again on the call side to the other one that you are buying to set up a 1x2x1 butterfly. Well, you skip that strike, and then you go to the next strikeout that's equidistance away, and you effectively end up selling a short call spread that will pay for your butterfly. That's the whole goal of it. That's the whole reason why you do a skip strike butterfly. As a matter of fact, I've built it before on the show as an alternative to just selling a call spread. Because by doing the skip strike butterfly, you do want the stock to come up towards your strike closer to that expiration date, because butterfly does the best if it closes right at that short strike overall. Okay, so that's a big intro to skip strike butterflies. But if you are a frequent listener of the show, you know that this is one of the trades I'd like to do on a little bit more pricey stocks overall. So with that said, I probably would have wanted to do a skip strike butterfly on Coinbase before the earnings. I don't mind that trade, but this one is such a volatile stock overall that you really don't need the added angst that is created from the potential earnings report and what's going to happen after it. So higher price stock, still trading at high volatility. Let's do a butterfly. So here we go. Okay, so how are we going to set up our butterfly? Well, first of all, we're going to go to to the option chains inside the Ally Invest live trading platform, and we're going to see where the underlying stock is at and the November 19th expiration. So we're going to start by looking at the long call and the long put for the most at the money strike. And as I mentioned, right now we have Coinbase trading at right around $331 and some change. So we'll look at the 330 strike. Why are we looking at the 330 strike, Brian? Well, we are doing it because we want to know what the expected move is overall by that expiration date, not the front month. We're looking at the expiration that we're choosing. And if you bought the call and you bought the put, the call is a little bit in the money, so it's trading for about $14.70, and the put is a little bit out of the money. That's trading for about $14 overall. So if you add those two together, that kind of gives you an expected move or what the marketplace thinks the potential could move. It doesn't ever have regard to direction. It's saying up or down overall, but it's kind of the line in the sand, the over-under on the stock by that expiration, if you will. And 14 plus 15, it's not an exact science. That's $29. So we at least want to go to the 360 level. Right? Because the marketplace says that that's an easy move to get to, but I'm a little bit nervous because if we get a big bounce back, right, our risk is that it blows away the expected move and shoots right through our short strike and keeps going. So the fact that we're going to go a little bit further out in time, that we're going to do the November 19th expiration as opposed to the very first expiration that's available, which is the November 12th expiration, this Friday, it means to me that we're going to go a little bit further out in strike. So we're going to start on the 385 strike call. We're going to go 15 points wide. I looked at a 20-point wide one, but I couldn't get it done for a net credit to the account. So sometimes if you tighten it up a little bit, you don't have as big of a landing spot, but that does sometimes help getting the trade done for a net credit to the account, and that happened to be the case in this. So we're going to be buying the November 19th expiration, 385 strike call, going up 15 points, selling the 400 strike call, then skipping the 415 and buying the 430, effectively creating a risk from 415 to 430. That would be our risk range. We're skipping that strike. And that means that we have a 15-point wide short spread that is paying for our butterfly. That 15-point wide short spread means that we are going to have a margin requirement. But if we do that entire trade, we are going to get it done for a 23-cent net credit to the account. A 23-cent net credit to the account. Okay. So if the stock stays where it's at, stock continues lower. If the stock just goes up a little bit, we're still going to make 23 cents minus commission on this trade. All the options by that expiration date, if they all expired worthless because they didn't go up enough, then we at least make that 23 cents. Now, if the stock comes up, ideally, we would like it to slowly start creeping towards our short strike. And we're going to have about a 40 or 30-point landing zone, which is about 10% of the actual stock price with the price at 330. 9% is a better estimate. But you have that range that you really want that underlying stock to land in. You don't really want it to go beyond the 415 level overall. So the expiration date on the 12th is 9 days away. If it stays where it's at, it's fine. It's basically a little bit of a lottery ticket, but you have an additional risk. A pure lottery ticket would be to just go out and buy the butterfly overall, not skip the strike, and you pay a relatively small net debit for that trade. Okay. So here is the paper trade to recap it. We are going to go out to the November 19th expiration in Coinbase, symbol COIN. Underlying stock right now is at 331.47. We are going to buy the 385 strike call, sell 2 of the 400 strike calls, and buy 1 of the 430 strike calls. We'll be doing this if we can fill at the midpoint at a net credit of 23 cents to the account. We do have additional margin, 15 points, so that means we're going to have to put up $1,500 to put on our trade. And the only way that we lose that, max, at expiration would be if the underlying stock was above 430 on the expiration date. All right. Well, IWM, we looked at it last week, and we just bought a long call. The trade didn't do much at all. The option contract, the contract that we bought was the 245 strike call going out to December 17th overall. And if we look at the trade, we've got plenty of time left. The chart is still looks decent overall, and that option contract is down about 50 cents. We paid $3.84 for it, trading for $3.22. So no big deal there. We'll maybe come back and look at it, and if we get a little bit of a spike up, we'll talk about a potential move or what we would like to do with that underlying. So that's it for this episode of Options Playbook Radio. If you have any questions you'd like to send me, please send them to theoptionsguy@invest.ally.com. Also want to let you know that I will be doing a very basic 3-part series on option trading. They're all going to be about 45-minute sessions. They're going to be starting on November 30th on the Ally YouTube channel. And if you'd like to register for that event, please go to ally.com/options with an S for rookies. All right, options for rookies, and write out the word for, F-O-R. And then you can register to get all the reminders, and we will hopefully share it with your friends. If you know some people that are some basic option traders who'd like to learn the vernacular and all of the workings of the marketplace, please send that link to them. Let them know it's free for all. All right. Thanks for coming, everyone, and thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.